G'day everyone, welcome to this weekend update again for the Australian market in particular, but also for global markets. And there's really been no change since last week. It was a shortened week of trading in America with Thanksgiving, and we're still in exactly the same position that we've been in for the last few weeks. The American market has risen slightly, which just means that we're that much closer to some sort of eventual correction. And as I'll discuss in this video, the risk reward is really just not attractive for doing very much in the market at the moment. So the best plan of action is just to basically have to sit and wait it out. The opportunities will come, they always do, and you can make money very quickly. So the worst thing you can do is try and force the pace at the moment. So the big question is, can this rally in America continue? Obviously it can, but the higher it goes and the longer that it goes without a correction, then the more likely it is that we will get one. So let's have a look at, first of all, the trading results, which I report on the first weekend of each month. So these are all the recommendations that are made to Specialist Share Education members. And we're recording for the calendar year, so we've almost got a full year up at the moment, and we're in profit by 6,612, which is down about $100 from the last month for those that have been following. So there's been virtually no change. That was based on closing prices as of the 30th of November. Now it's on a $20,000 trading float, so it's still a pretty good return, and using $300 fixed risk per trade. And in this calendar year, we've so far taken 57 trades. 74% of them have been winning trades, which is an extremely good success rate. Very pleased with that. The win-loss ratio, in other words, the size of the winners as against the size of the losers, has slipped slightly. It was up around about 1.8. It's slipped down to just under 1.5 of late, and that's because we've taken some profits on some trades because I wanted to pull back our exposure in the market. Some of the really good stocks that I'm highly certain will be progressing to higher prices over the next few weeks or few months, they've all slipped back as basically the entire Australian market has. And so we've taken some profit, closed those trades, and that's just dragged that ratio down a little bit. But it's setting up for some very nice entries, so we can push those numbers up again very quickly. But certainly the 74% win rate is extremely pleasing. Now let's have a look at the summary for the week. The S&P did set a new all-time high on Friday night. But there was a sell-off in the last 30 minutes that meant that the S&P index rose just 1 point on the week. So 1,813 was the new all-time record high in what was a shortened trading week, so really only 3.5 days of trading. But interestingly, the Russell 2000 and the Nasdaq are still extremely strong, and in fact they're stronger than the S&P. And that's a really good sign when technology stocks and the smaller mid-cap stocks are outperforming the main index. That indicates to you that there's no underlying weakening of the market and that the index is just being held up by, the top 10 or 20 biggest stocks. That's definitely not the case. In fact, if anything, those smaller and technology stocks are actually doing better. The Australian index, we've been underperforming most of the year. We certainly did again last week. We were down by 15 points, and the Australian market is just really disappointing at the moment. It's quite low liquidity. The market depth, particularly when you get away from the majors, is very thin, and as a result we're getting this really minor selling into a very thin market depth, and it's pretty much across the board, and it's really a bit meaningless when you see the price of really good stocks dribbling down to well below what would be a reasonable valuation. I'm sure it'll bounce back, but there's just no point in having exposure in the market at the moment, because if the US market does move into a corrective phase, then there could be some further sharp downside and some much better entries. Now, the reason that I think this is the case in Australia, there's a couple of reasons, but I think one of them is that we need international investors coming into our market, particularly into the banks and Telstra and BHP and Rio and all those major stocks. And the Australian dollar's falling. The Reserve Bank is clearly desperately trying to push it down. So international investors looking through their eyes would see the Australian market as being pretty unattractive, because even if they make some money on the stock or on the dividend, then they're going to lose it on the currency exchange. So I think that's keeping away a lot of the international money that would normally be making a positive contribution to our market. So that's one reason. The second reason is that the majors are pretty fully valued, and we've got definitely some faltering consumer and business confidence. There's just a lack of confidence in our economy to do very much at all. So when you've got the major stocks right up there at full valuation, international money probably staying away, then there's really only one way for the market to go, and that's to slide back a little bit, and that's exactly what's been happening. So let's have a look at those couple of indices, and we'll start first of all with the S&P index. So you can see we've broken out of that wedge pattern that had formed, but it hasn't really scooted away yet. You can see on Friday night, Saturday morning, it did go up to a new all-time high at 1813, but came back and closed on the lows. Now, if you just look at this last few weeks, we're getting, it just looks like it's running out of momentum, doesn't it? You look at this period here from the 28th of August to the 18th of September, nearly 3 weeks, virtually moved higher every day. We got a correction, and then from the 19th of September through to the 29th of October, it moved higher almost every day, and most of the closes on the highs. Now, since then, we've had another little burst here, which was pretty useful, but we're starting now to get more closes on the lows, and the upward momentum seems to be waning. So I wouldn't be surprised if we see a correction in the not too distant future. I hope we do, because it's really preventing us from doing much with any real confidence at the moment. Just to have a look at the Russell 2000. You can see it's looking stronger than the S&P, particularly in the last couple of weeks. That's actually an outperformance by the Russell 2000, so extremely positive signs there. Turning now to the Aussie index, by comparison, you can see how relatively flat and weakish our index has been, and because of that sentiment, it's just really preventing everything across the board. Everything in the top 400 or 500 stocks is hardly anything doing any good at all at the moment. So we've really got no alternative but just to sit this period out. Now, turning to gold, gold rose by $7 on the week. You really can't pick the direction. Lower levels are possible, higher levels are possible. There's really no direction at all on gold. And there's really nothing positive coming from the gold stock indices either. So let's just have a look at gold. So we bottomed out in June, 28th of June at 1191. The market then rebounded. Since then it's fallen into a declining channel. We had a little bit of a breakout of that channel, but then it's just gone straight back into another parallel channel to the downside. So there's really nothing positive there on gold, and it's best just to stay clear of gold and gold stocks for the moment. This is the GDX index. We've had a couple of goes at moving to the upside. Looked very promising here in August. But again, it's just sagged back down, and we've actually formed, just in the last few days, formed another lower low. So really no outperformance from the gold miners index that you would normally get. Turning now to copper. Copper indicator, best indicator for the health of the global economy. It's holding steady at 320. Just as an aside, the iron ore price is holding up extremely well, $130, $140 a tonne. So there's really nothing untoward in the global economy. It's just the Australian economy is struggling a little bit. Now, oil was down a little bit to 93. The impact of all the oil they're finding in America is starting to filter through. The fact that there's not as much anxiety over the Middle East is also starting to filter through. We may have Iran coming back into the world market. And so it's all combining to push the price of oil down. So oil stocks, I'd be pretty cautious on at the moment as well. And there's the 6-month chart on spot copper. So you can see it hasn't done a lot for quite some time. So from an overall strategy point of view, look, there's no change. Short-term correction still has to be a high probability. And as I indicated last week, it's not just because the index has gone up. However, the higher it goes, the more profit you've got baked into the index, the more likely you've got that a few big players will start to take money off the table. When that happens, you can then get the computer programs start to kick in and start to trigger off trailing stock exits, and it then creates a bit of a cascade, and you end up getting a bit of a short-term correction to the market. So human psychology demands it, and computer programs certainly amplify the effect of it. So right now, the reward for risk is just very poor. So my overwhelming advice is to wait for some sort of correction or dip in the market. Yes, you could make a bit more money on the upside. The US market could go up a little bit further. But look, the Australian market is not following it. So you're not really, if you're not in the Australian market in a major way at the moment, you're not really missing out. And you've got your cash safe for the opportunities which will eventually present themselves. So that's it for this week. It's just part of the waiting game. The reality is good trading is about making money when the opportunities are the very best. The reality is you make most of your money in 3 or 4 or 5 concentrated months in the year, and you've just got to wait until those good opportunities present themselves. If anyone wants to talk about trading, how you could do better in the market than perhaps you are, then I'm very happy to chat with you. Send me an email to that email address, and look forward to talking to you again next weekend. Cheers.